But here's the first thing to understand. This isn't just about raw numbers. While it's true that open interest and registered inventories exist, the way people interpret these numbers matters a lot. Some analysts have calculated that if all possible silver eligible for delivery were converted to registered inventory, there would still only be about 390 million ounces, short of the 429 million ounces of open interest. On paper, that looks scary, but we need to dig deeper before jumping to conclusions. Next, it's important to understand how COMEX deliveries actually work. February deliveries, for example, are considered destination months. That means most people who hold contracts past the first notice day really want actual delivery. March, on the other hand, is a major month for trading, but not everyone intends to take physical delivery. Banks, hedge funds, and other investors participate differently, and many will roll their contracts into future months instead of demanding silver. Another key point is that delivery numbers are often misunderstood. When COMEX reports a delivery, it doesn't necessarily mean physical silver is leaving the vault. Instead, ownership of a warehouse receipt changes hands. The silver itself might stay in the same vault indefinitely, being transferred digitally through multiple owners. So, a high number of deliveries doesn't automatically signal disappearing silver. Finally, one of the most common mistakes in silver panic analyses is how percentages are calculated. Some analysts took a snapshot of open interest on a single day and divided total deliveries by that number. But open interest is more like water in a bathtub. There's a constant flow in and out. Using just one snapshot without accounting for the flow over time leads to a denominator error, making the delivery rate look far higher than it actually is. By keeping these factors in mind, delivery intent, major versus minor months, and how physical silver actually moves, we start to see that the situation is not as catastrophic as it's sometimes portrayed. The hype often exaggerates the problem without considering the full mechanics of COMEX trading. Now that we've laid the groundwork, let's take a closer look at why March silver on COMEX isn't as dangerous as some headlines suggest. One of the biggest mistakes people make is assuming that February's delivery patterns automatically repeat in March. In February, the delivery rate was reported as 98%, but that month is considered a minor month. The majority of participants who hold contracts past the first notice day genuinely want delivery. March, however, is a major month, attracting a wide range of investors, banks, hedge funds, and traders, many of whom treat delivery as just one option among many. Most will roll their contracts forward or sell them rather than standing for physical silver. Let's simplify this. Imagine February as a narrow river where almost all water flows straight into a destination pond. Delivery is the goal. March, on the other hand, is like a wide river delta with multiple channels. Some water will reach the pond, but much will continue flowing elsewhere. That means the percentage of contracts that actually stand for delivery in March is expected to be much lower than February, even if open interest is higher. Another important factor is how open interest is measured. Some analyses take a single snapshot of open interest and divide deliveries by that number, which can make delivery percentages seem inflated. But open interest is not a static stock. It's more like a flowing river. New contracts are constantly added and others are settled or rolled forward. To accurately determine delivery rates, you'd need to track all eligible contracts over the entire period, which is a lot of work and not always publicly available. In reality, the true delivery rate is much lower than the exaggerated 98% figure. We also need to clarify what a COMEX delivery really means. Many people picture silver physically leaving the vault, but that's not how it works. When a delivery occurs, ownership of a warehouse receipt changes hands. The silver itself can remain in the vault indefinitely, simply changing digital owners. So even if deliveries appear high, the actual silver inventory doesn't necessarily decrease. This is a key detail often overlooked by those trying to create a panic scenario. Now let's look at the math behind the hype. Some analysts argue that with 429 million ounces of open interest and only 100 million ounces of registered inventory, COMEX is in serious trouble. But if we include eligible silver that could become deliverable, the total rises to around 390 million ounces, still slightly short, but far from an imminent collapse. The numbers do not account for participants rolling contracts, choosing cash settlement, or other standard market behaviors. It's a situation that seems scary on paper, but is manageable in practice. Finally, consider inventory flow. Reports suggest COMEX inventory is draining at 780,000 ounces per day, but this is just a snapshot. The inventory constantly changes as deliveries are assigned, contracts roll over, and new silver enters the system. Using one day's data to predict a default is like forecasting a hurricane from a single raindrop. It doesn't capture the full picture. By understanding these points, differences between major and minor months, flow versus snapshot of open interest, and the mechanics of delivery, we begin to see that the idea of COMEX running out of silver in March is largely a misinterpretation of data. The system is designed to handle variations in demand and supply without collapsing, and historical trends support this. So, after breaking all this down, what does it mean for silver investors? The short answer: the chance of a COMEX default in March 2026 is extremely low, around 0.011%, maybe 1 in 10,000. Yes, there's always a chance, but it's so tiny that it's not something to base your investment decisions on. Understanding the numbers and the mechanics behind COMEX deliveries can save you from unnecessary panic and poor decisions. Remember, COMEX is a carefully regulated system. Even if there were a stress scenario, it wouldn't mean silver prices shoot to infinity or that gold would automatically skyrocket. Trading would likely pause, reporting and regulations would kick in, and there could even be government oversight or taxes involved. It's not a situation where investors simply cash in unlimited profits. In fact, a real breakdown could make it harder to sell silver at all until the market stabilizes. So rooting for COMEX to fail is not only risky, it's not in anyone's best interest. For silver holders, the key takeaway is this: focus on long-term trends and fundamentals rather than short-term panic. COMEX is not disappearing. Silver is not vanishing from the vaults. February and March delivery percentages are not comparable, and deliveries do not necessarily mean physical silver is moving. By understanding these points, you can avoid the hype and make smarter investment choices. If you're still wondering about the bigger picture for silver, it's worth reviewing long-term trends and forecasts. There are multiple factors shaping the silver market: industrial demand, investor sentiment, and broader economic trends. These are far more meaningful for price action than a single month's COMEX delivery numbers. And if you ever lose sight of why silver remains a strong investment, it's always good to revisit videos that explain the trends, forecasts, and price predictions in simple terms. Before we wrap up, I want to remind you that all content on this channel is for educational purposes only. Nothing here is financial advice, and it's always important to do your own research before making investment decisions. Markets can be unpredictable, and you should consider your own risk tolerance before buying or selling precious metals. If you found this breakdown helpful and want to stay updated with gold and silver insights, don't forget to subscribe to Gold Silver Scope. We cover market trends, forecasts, and tips to help you make informed decisions about precious metals. Hit the notification bell so you never miss a video, and join our growing community of smart investors who want to stay ahead of the market. By understanding the facts instead of getting swept up in hype, you'll approach silver investing with confidence, clarity, and a clear strategy. The COMEX panic is mostly a misunderstanding of how the market works, and by knowing the details, you can focus on what really matters: smart investing for the long term. Thank you for watching, and I'll see you in the next video on Gold Silver Scope.